Hi there, my name is Todd Miller, better known as Tightwad Todd. I created an 11-part video series as an introduction to personal finance. This is the 10th video in the series, and today we're going to talk about some common financial pitfalls. But before we do, just a little bit about me. I'm a financial coach. I help busy professionals just like you transform a six-figure income into a seven-figure net worth. I'm the creator of tightwadtodd.com, where I post videos, have a blog, and send out a weekly newsletter. So if you like my content, please subscribe. And I created this video series to help everyone get better with their finances, no matter where you are today. And this slide just covers an overview of the entire video series. If this is the first one that you found, I would encourage you to go back and start with the first video and work your way through the entire course. It'll be most beneficial for you if you do it that way. So again, this is the 10th video, and today we're covering common pitfalls. So by the end of this video, you're going to be able to identify some common financial pitfalls. You're going to have some strategies to avoid these pitfalls, and then you're also going to realize how important it is that you start today. So what are financial pitfalls? Well, they slow or completely derail your progress towards your goals. Not just that, but sometimes they can lead to even larger financial difficulties. While it's important to be aware of these financial pitfalls, rarely is it impossible for you to recover from them. So the first one is not having and maintaining an emergency fund of some sort. Unfortunately or fortunately, life is full of surprises, depending on whether it's a happy surprise or a not so happy surprise. It's not a matter of if, but a matter of when something negative is going to happen. And you may need them for a loss of income. When I started working, I lost my job pretty quickly, and I was without work for about 4 months before I found my next job. And if it wasn't for my emergency fund, I would have had to go into debt in order to survive. Also, unexpected medical bills. Unfortunately, nearly 66% of all bankruptcies are linked to medical debt. So it's important to have not just insurance, but also an emergency fund to be able to pay your bills. Also, vehicle repairs. You never know when you may get a flat tire or have engine trouble. Home repairs, family emergencies, and all sorts of other events that you're not even thinking about may happen. The good rule of thumb here is to have 3 to 6 months of your expenses set aside in a savings account that you don't touch and it's just there for emergencies. Another common financial pitfall is not having a financial plan. And like the old saying goes, failing to plan is planning to fail. Instead, we need to have a plan for our money. So, what do? We budget our money so that we have a plan to save and to use our savings to achieve our goals. But not just that, we also need to consider debt. When is it appropriate to take on debt? And when is it not appropriate to take on debt? A lot of personal finance has to do with long-term planning. For instance, when you need to make a large purchase or want to make a large purchase, will you use debt or will you create a savings plan in order to make that purchase in cash? Also, how will you pay for your children's college education? And what about your own retirement? How will you work towards saving money and creating a joyful retirement? But not just that, we also need to account for estate planning. What do you want to have happen to your assets after you pass on? The most common pitfall is financial comparison. And I'm sure the concept of keeping up with the Joneses will hit home for most of you. And this is exactly what financial comparison is it's the idea that you are purchasing goods in order to keep up and show off some sort of a status. So how do people do that? Well, they buy different types of status symbols. And some examples of those are McMansions, luxury cars, and designer clothing. But it's important to realize that the truth about the Joneses is that they don't have financial goals. They're not like you. They don't have savings, and guess what? They are drowning in debt. So to avoid financial comparison, it's important that you accept where you are now and then do some self-discovery and figure out where you want to go next and then start working on it. The final financial pitfall is not making changes today. And the reality is that the longer that you wait, the more money it's going to take for you to reach your financial goals. When you save less money, you actually end up needing to save more of it. Not just that, but you have less time for your money to compound, so you end up needing to save more of it. So I'll be able to illustrate this point in an example for you. So let's assume that you're 30 years away from retirement and you need $1 million. You can either start today or you can start in 5 years. And we're going to assume that you can earn an 8% annual return. Here's how it plays out. So if you started today, you'd only have to save $736 per month, and you'd only end up contributing just under 265,000. Whereas if you started in 5 years, you'd have to save over $1,100 per month, and your total contributions end up being over $342,000. So by starting today, you end up saving over $77,000. And another way of saying the same thing is that by waiting, it's going to cost you over $77,000. The choice is yours. Well, that's a wrap for this video. I appreciate you being here with me. Coming up next, we have the entire course wrap up. I hope to see you in the next video. Thank you so much.